Hello, welcome to Globaleye's weekly review of the main economic and business stories making the headlines during the past week. Joining me again to discuss these matters is our senior wealth manager, Simon Putt. So Simon, let's start with US interest rates and clues from Janet Yellen last week that there may be an interest rate rise on the cards.
I'd say more than a clue. I think a very forthright statement that the expectation is there for rates to rise unless something unexpected happens in the interim. I mean, this week we do have non-farm payrolls data from the United States and wages data as well. I think as long as those data releases are within broad expectations, we should look for the rate increase to come in the following week. Where this leaves us is, as I say, very much broadly in line with the expectations we've had for a long time. We have to keep in mind that we've only had 2 rate hikes in the last decade, which is perhaps unprecedented. One of the signals that she has been given is that even if rate hikes are not going to be pronounced, they're going to become more regular. We're going to come back into a more normalized monetary policy setting scenario, which in the end is welcome for an economy that is doing well at the moment.
And this sort of ties in with President Trump's speech to the joint session of Congress last week. I mean, this is monetary policy we're talking about, not fiscal policy. It's not a result of Trump saying, look, we're going to spend $1 trillion on the infrastructure, etc., correct?
Obviously, a government also has monetary policy as a tool for managing the economy, the pace of growth, and we're looking like we're coming into a tightening cycle again. I think the important thing is not so much the quantum of the increase in rates that may come later this month. It's going to be longer term about the regularity of rate hikes. And so the markets are looking for 3 hikes in the course of this year. In terms of what that's going to do for interest rates, let's keep in mind that we are at incredibly low official rate levels, and we have been for the last 10 years. We're in this range of 0.5 to 0.75%. Markets are looking for around 1.4% by the end of this year, and in terms of going ahead future years, 2.1% in 2018, 2.9% in 2019. What's the broader context for that? Well, if you look pre-financial crisis, US rates were around 5%. So we're still going to be very low on a historic basis. So there's nothing there particularly to spook the markets.
And hopefully this will have a positive effect on the fixed interest market, which has been, I guess, in the doldrums a little bit.
Yeah, certain sectors you'd imagine to do well. I think of the financial institutions who obviously been coping with and languishing with low interest rates. The ability for them to make money out of money has obviously been compromised over the last decade. An increase in rates will lead to an increase in yields. Financial institutions should see themselves doing a little bit better. And we've already seen that reflected to an extent in some of the numbers from the US financial institutions that have come in the first quarter.
So turning to Asia, and the Chinese government announcing the other day that their growth rate has been revised down from 7% to 6.5%. Is that such a big deal globally in global terms for growth?
Not on the face of it. I mean, there have already been plenty of market forecasts that Chinese growth is going to be in that region of 6.5%. The government has rubber stamped effectively what was already out there as a market consensus. 6.5% is still an impressive growth rate if you look at the global context. I think the challenge that we're looking at here is, China has traditionally been a manufacturing and trade-driven economy. That's what really spurred the growth over the last few years, and it's going through this transition now to a more services-led economy, which is a healthy sign for a maturing economy. So, big picture, there shouldn't be something here that's destabilizing, and then at the same time, in terms of a wider region, because obviously the whole ASEAN and Asian region is so directly impacted by Chinese growth, there should still be there enough for the region to be well supported in terms of their own growth prospects.
So, Simon, we've continued to see all-time highs on stock markets, and the Dow's over 21,000 at the moment. What's your advice to the average man in the street, the investor? Should he still be pumping money into equities, or are we likely to continue, or should he be more cautious?
Well, I think it's about being a bit judicious, and as you say, cautious. I mean, there is still the potential for growth in the markets. the signals from US corporate sector, and as I mentioned earlier, the financial sector is positive. There's still some growth there potentially to be harnessed, and it would be a shame for investors to miss out on that opportunity. But using the word judicious again, I think the important thing is to build some diversity into a portfolio. Any grade 1 financial analyst who's just starting out on their CFA will tell you first thing is to have diversity in your portfolio in terms of achieving growth and preserving growth. So from that point of view, yes, have the equities exposure, be careful of the sectors that you're in, but at the same time look to build some asset diversity by way of, for example, fixed income, cash, perhaps a little bit of properties and commodities exposure. So at least, while equity markets are doing well, that's great. If equity markets correct downwards, at least you've got some insulation and downside protection there with the cash and fixed income. So as I say, a diversified portfolio is the measured and judicious way forward to managing investments.
Great. Simon, I'll have to leave it there. Once again, many thanks for your thoughts, and we'll see you again soon.
Thank you so much, Tony.